markets. Joining us, Matt Orton, Chief Market Strategist at Raymond James Investment Management. Good day to have you on, Matt. We're not making too much of this decline, but you and I were chatting right before, we came out of commercial break. And the reason a day like today is getting, I think, more attention is that we haven't had many of them, right?
That's exactly it. I think investors forget that the market can go down and that it's very, very healthy. And that's why I've been telling our clients that you should look to use downside opportunistically if you get it and fade the froth in the market. There's a lot of high quality companies who have posted really, really strong earnings that might happen to be levered to some.
What does that mean, fade the froth?
Fade the froth. So a lot of the nuclear names, a lot of the crypto type names, the quantum names that have really rallied, I'd say disproportionately with respect to the earnings or even the revenues that they may or may not have. And instead, look to buy the high quality companies that are growing at double digit top and bottom line numbers who are levered to sustainable long-term trends like AI.
I think you're, and I don't put words in my mouth. If I'm wrong, tell me. I think you're describing the difference between trading. There are bars in South Korea now. You can go to a bar, true story, and watch people trade. Like we watch football. They're watching people trade, and I think they're betting on those traders. That's not investing. That's trading, or some people might even say that's gambling. There's a difference.
There's a key difference. And I think what we need to remind ourselves as long-term investors is that the market goes up, it goes down, but you want to invest in earnings growth going forward. And there's been a lot of, I'll say, euphoria in the overall market, but we're lucky. We're in earnings season right now. We're seeing a lot of these long-term durable trends like artificial intelligence, the CapEx super cycle, continue to show durability. And that's what I want to lean into. If there's weakness in companies that are posting really solid results, like a Sterling Infrastructure, a name that's levered to data center buildouts, those are the types of names that I want to make sure I'm long and stay long. And especially if there's downside, use that to your advantage.
That's interesting because I would put some of the data center companies in your previous mix, but it sounds like your company, Sterling, you don't feel like it's maybe gotten the love or the froth of some others.
No, it might be really big this year, but they just reported results last night, and you're seeing double-digit earnings growth. Not only do they have a backlog back to 2029 with very significant visibility, their margins are actually expanding as they continue to build out data centers. So those are the types of companies I like to see: improving margins, visibility into earnings going forward, and levered to a durable theme like AI.